Can everyone hear me at the back there? Perfect. Welcome to today's session on collective intelligence. I'm Lisa Pretorius, and I lead sustainability analysis work at Matter. We're a Danish fintech that specializes in sustainability analysis for institutional investors, with a focus on multi-stakeholder definitions of sustainability. Now, before I introduce our panelists, I might just take a moment to set the context of what the topic is about. I've had a couple of questions in the last 2 days around, what is this thing about collective intelligence? It makes no sense. So I might just explain what we're here to talk about. So essentially, we're at a time in the evolution of sustainable finance where two things are happening. One, we're moving away from this notion of privatized definitions of sustainability, historically in the form of ESG ratings, towards more publicly defined and accountable multi-stakeholder definitions of sustainability. At the same time, investors have more data available to them than ever before. So it's not just company reports, it's Earth observation, it's NGO insights, it's think tanks, academic research, AI models, the media, law cases. There's information everywhere. And for these two things to actually support better decision-making and ultimately actually guide capital towards the transitions that we need to see, we need a couple of things to happen. So we need this data to be usable. We need it to be setting rigorous sustainability standards and expectations, often across quite complex topics. And we need collaboration between different voices so that it's not just a bunch of noise, but that investors can actually say, hey, I'm not an expert in everything, but there is expertise on physical risk that I should listen to. There is expertise on AI ethics that I should listen to. There is expertise on biodiversity or on cybersecurity. There's so many multi-stakeholder expert voices out there creating the insights, creating the expectations, and creating the data that we really need to be able to harness. So that's what the discussion is about today. It's about how do we do this? Why is this important for Sustainable Finance 3.0? And also getting quite real around the challenges, things like usability, what is that, coverage issues, comparability. And so with that context, each one of our panelists today is working deeply on a piece of this puzzle. And so really excited to have you here and to have your insights shared with us. So we have Ray Dirani, who's Head of Impact Management at Tribe Impact Capital. Then we have Felix Preston, who's Head of Strategic Research at Climate Arc. Then Joe Raven, Policy Director at FAIR. And then Nikki Gulim Bihari, Strategic Investor Lead at WorldBenchmark Alliance. Also, just for everyone, we've got just over an hour and 15 minutes-ish. It would be great for the session to be interactive, so we will have space for questions at the end, but if you want to jump in and jump into the conversation and ask a question if we're on any topic, just put your hands up and we do have a roaming mic. Okay, so I'm going to start with a question for Nikki, Joe, and Felix. So each of your organizations basically exists to get insights to investors that reflects a very deep expertise or subject matter expert, and to help them implement these insights. So what is this intelligence gap that your organization is solving? In other words, what is not already being solved by the current state of sustainability data in the form of corporate disclosures and ESG ratings? Maybe we'll start with Felix.
All right, I was expecting us to go. Nice to see everyone, and thanks for including Climate Arc on this panel, and thanks for the intro, Lisa. So for those of you that don't know, Climate Arc is a relatively new, one-year-old now, philanthropic organisation focused at the intersection of climate and finance, and more specifically about getting quality transition analysis focused on climate into financial decision making. And a lot of our work is done through and with partners across the ecosystem, including WBA in particular on the panel today. And for me, the collective intelligence term actually captures something quite important about the way that we work, because it's not just about sort of adding up the sum total of the work that we do as a community. It's about how that gels together and leads to kind of the next phase of climate action and transition and sustainability more broadly, I think. I really enjoyed the last session in the other room about, which is particularly the conversation on aligning the existing frameworks that we've got. But going beyond that, we actually need to operationalize those, as was mentioned in the previous session. And I think it's about how we join up our work in a practical way. And as I say, make that more than the sum of its parts. So that's what it means for me. For our work, because we're focused on getting science-aligned transition analysis on companies, so of the real economy, but into financial decision-making, we are working with a number of different organisations who specialise on analysing different things: decarbonisation trajectory, the quality of targets, capex, and several other important transition metrics. The reality is that while there's great work done today, it's done on a relatively limited number of companies. So if we want to mainstream this into financial decision making or for other purposes, we're going to need to do a lot more. But we probably can't do it in exactly the same way as we've done it now. It's not exactly scalable. So many of the opportunities that Lisa mentioned in her intro about how we apply different kinds of technologies or work differently together has to be a large part of this. Also, probably the way that we've done this work means that it was often done for different purposes originally. It's not necessarily tailored to the different use cases. So we're thinking about financial institutions as end users, could equally be policymakers or other audiences. We're going to have to get much sharper about how our work kind of meets what the need is and how we work together to get there. And so for me, this is obviously at some levels a technical challenge, and we tend to focus on that because that's some of the nitty-gritty that we know we have to get done. But actually, the most important thing is about how we figure out almost the social aspects of how we interact as different organisations and build some kind of sustainable model that's delivering what we need, working together. So for me, that's the collective intelligence that we're trying to deliver.
Thanks, Felix. Certainly a lot of work going on in the climate space that I think will hopefully be followed by other topics. Talking about other topics, food systems, Joe, is a very, very juicy one. Could you share some of the opportunities and challenges on this topic?
Thanks, Lisa. So FAIR was really set up back in 2015 with a specific purpose of addressing a knowledge gap, which was looking at our food and agriculture system to understand how is it that we consume and produce food, and what does this mean from an investment perspective. So many of the reason why we were set up was because investors were really focused on mining, utilities, heavy industrials as sectors, and looking at it from a climate perspective or other ESG factors. But food and animal agriculture in particular was not part of that conversation. So a lot of the large farmed fish, dairy and meat producers were not covered by mainstream sustainability indices, despite the fact they've got a huge impact, massive contributors to climate and biodiversity loss. So our work is very sector specific. We specifically look at that protein value chain, whether it's traditional animal protein or alternative protein technologies coming down the pipeline, and providing investors with data, with thematic research on these issues. And actually when we started, because these companies were not covered by these indices and investors were not really scrutinizing these companies, it was a little bit of a black box from a data perspective, right? So we had to start completely from scratch in that regard. So to build up disclosure levels, to work with companies directly. So for us, it's all been about filling a knowledge gap. And now we do benchmark a lot of these companies. We have several different indicators across 10 material ESG risk factors. And the level of engagement that we see from companies is also really high. So, but it's still a work in progress, because it's still one of these sectors where we're talking about transition pathways for the energy sector, perhaps, and that's a lot clearer. But when we talk about animal agriculture, it's still a big black box.
Interested to, I'm not sure if you know this, but are these companies now covered by the ESG ratings agencies?
They are. They're starting starting to be, and you're starting to see as well from a lot of collaborative investor initiative out there where food and agriculture is now having a lot more emphasis on it, but it's still not where it should be relative to other sectors.
Yeah. And this is probably also where the point of sort of using subject matter experts to have more, or to set more stretching expectations for companies on specific issues. Nikki, World Benchmarking Alliance works across a lot of topics, including both with FAIR and Climate Arc, if I'm not mistaken. Can you tell us a little bit about that? Yeah.
Yeah, I mean, that's probably the first point to make. It's not a surprise that actually the people on this panel that we have been connected and that we do work together. That's important as a starting point.
I did not design it like that, by the way. It just happens to be that there is a lot of collaboration going on.
So I was pleased to see that when we were put together on this panel. No, so going back to the question. So the World Benchmarking Alliance, we're a not-for-profit organization. So we're really focused on accelerating corporate sustainability practices. And I think to answer your question of, where is this different to maybe what we've had before or complementing the work, the first layer that I would emphasize is the lens that we take when we look at companies. So maybe talking to a kind of sustainable finance audience, maybe often the lens of a data assessment or a company screening process might be from a financial lens. What topics are financially material? Our starting point in our lens is what are the planetary boundaries? What's the carbon budget? What are the societal baseline needs and expectations? And that's where we think from a systems point of view of then what company action is needed to appropriately act within this context. And of course, that's the starting lens, and my main work is with investors, so I'm quite open and transparent to say that's where we start from. Of course, then, these do become, and they are topics that are business risk and opportunity, and increasingly so. So as, of course, natural resources get more scarce, as social cohesion declines, these topics are increasingly financially material, not just for a company, but also from a portfolio construction point of view. So the lens obviously then leads itself to being interesting from a finance perspective, but that's not the initial starting point or reason why we existed in the first place. And the other second gap I just mentioned, or the kind of key feature of our work, is it's fully open source. And that is, for us, really key and at the heart of, again, why we exist from this collective or collaborative point of view. It's really important that we're working, of course, with investors who have a lot of influence over the private sector, but we want to work with all actors, and we want the data to empower policymakers and every other type of stakeholder. We're going to come later to the challenges of getting the pitch right there, but at the heart of it, it's open source for that reason.
And a lot more transparent, actually, in terms of lifting the lid on what a certain ranking, where that comes from, and how companies have been compared, which is not always the case with classic ratings. Yeah. So really hearing this shift from kind of a focus on only financial materiality to really understanding how we need to look at companies' transitions, which is also what you're focusing on, Ray. And Ray's sitting on the investor side, which is a little bit of a different hat, but you've also worn many other hats in the past, including at WWF. But yeah, so we've chatted quite a bit, and we both agree that we are seeing this shift away from historical approaches to ESG data. You're specifically looking at how can we really understand impact. So my question is, what gaps still exist in terms of the data that we need, and what are the new concepts and tools that investors are starting to use?
Thanks, Lisa, and thanks for including me on the panel. And just for clarity, I have never met in person, Nikki, Joe, or Felix. So we do foster new collaborations as well as working through old alliances. And thank you to all for joining a post-lunch session, which is always difficult. So I think just a quick background on Tribe, which relates to the question. So Tribe Impact Capital was founded in 2016. The whole idea being that can we actually marry the concepts of impact and investment together cohesively? So we don't have any legacy assets. Everything we do has to have positive impact. And that's the view on which all the investment decisions are made. So that's quite exciting. It's quite sort of novel way of looking at the world and redefining finance, so finance for impact or finance for good. To your question, Lisa, I think that obviously the ESG data landscape is fairly advanced, but historically and still largely to date, it is backward-looking and inward-looking. So it looks primarily at the risks to the business, which are important. I think from our perspective, we often use ESG as a starting point to get a lens on, you know, is this a well-run company? Is this a company that understands risk? And so it can be a useful lens. However, where it kind of falls short is what is the onward impact to society, to people, to environment, to biodiversity, to some of the issues already raised by the panelists today. And in that sense, ESG is severely lacking. So it's almost that start point cannot actually comprehend that outward impact analysis. And the other thing is for impact is what we're interested in, you know, impact on people and planet. There aren't pure impact metrics. If anyone tells you, here's a pure impact metric that you can use to calculate your investment impact, that's not correct because they don't exist. So we're kind of in that area, and there's things being in development, but pure impact metrics don't exist. So a lot of what we do is we take ESG data as a starting point, and then we layer in qualitative and quantitative approaches and other data, you know, for instance, around satellite imagery for things like biodiversity and nature risk, you know, relating a lot to Joe's work, which is really salient in that area, because for biodiversity, you know, localized information is important. So we'd overlay that in and then be able to create, you know, impact scores or alignment to the SDGs, the Sustainable Development Goals, etc. So it's certainly messier than just looking at ESG data, which is certainly more standardized. But ESG data doesn't tell me what I need to know. So we've got to kind of find those overlays. And I'd love to be in a position where we have pure impact data at some point, but then data is only a piece of what we need to do. So ultimately, we're looking for positive impact, companies that are making a positive impact on the planet and people, and data will always play a role in that, but certainly not be you know, panacea for actually, you know, creating and measuring that impact over time.
So that's really the gap that you're seeing. You know, we're really actually well versed in measuring impact to the company, maybe not on all metrics, and there's still a lot of issues there, but there's a lot of work we still need to do to understand transitions across all our critical issues, from food systems to climate to our social issues. Felix, the climate space probably is the most advanced in terms of data maturity, the types of metrics that we have, and also the availability of data from companies and other organizations. But it's also facing this tension where it's still, as you say, facing a lot of the challenges of, you know, everything that you've mentioned. Data is not homogeneous, there's transparency issues, etc. The work that you guys are doing, what can we learn from, I guess, what you're trying to solve in the climate space, and how might we apply those lessons to other topics that still have quite a way to go in terms of data?
Sure, thank you. Maybe just firstly, just to support something that Ray's just talked about, because I joined Climate Arc a year ago from Generation Investment Management, and very much, of course, consumers of ESG data as a pure play investment firm. But just using ESG data off the shelf is never going to be enough to embed a serious analysis, particularly long-term investment view of how transitions are going to play out and the opportunities and challenges for that in individual companies. So very much coupling that with richer data sets, I think very much in tune with what's just been said. Climate being more mature and what we can learn from it. So we are, as I said, like we see ourselves as a bit of a platform really for best available science-aligned analysis of transition, what we have today and hopefully what we build for the future. And because we're building that platform, we are faced with dealing with all of these heterogeneous data sets, different data formats, different ways of sharing information, all sorts of challenges, and challenges that also relate to how easy it is to do the transparency work, among others. So I do think there is a lot we can learn from that. We don't necessarily need to go through that journey twice or 3 times for other challenges on nature and biodiversity related data, or it could be human rights related data and other important issues. But there's sort of 2 big buts, I'd say, for this. So firstly, sometimes we talk about climate data as if we're at the end of the journey. We're not at the end of the journey by any stretch. And it'll probably never be at the end of the journey. There's always going to be new and more sophisticated ways to understand the transition, and dynamics within the transition will change anyway. So we will need to continuously learn like that. So I'm just a bit wary of sometimes the community, I think, describes what we're trying to do as moving towards a static objective, which I'm not sure we are really. But also, different challenges, different issue areas do have their own dynamics, and so maybe we're pushing a little bit too hard in expecting the nature-related space to follow in the footsteps of climate-related work, when actually there are just some quite significant differences. And if anything, I would say, as climate work focuses more into the value chain and you start needing to get back to real-world space and place and context, if anything, the climate community is going to be learning from the nature work and people working on human rights in specific locations. So it's also not a one-way street. But just from the perspective of our work, we are building a platform, a kind of set of technologies that can speak to different kinds of data, and I think it's important that we kind of collaborate so that that work doesn't happen twice. And because obviously these issues are very much interconnected anyway, we need to kind of be able to bring that data together. And there is a bit of a risk that we confuse end audiences, in this case particularly financial institutions, by bringing them 3 slightly different overlapping ways of tackling a problem, and that could be quite counterproductive to all of our work. So yeah, there's work that we can hopefully learn from.
Yeah, that's definitely the usability point of, a lot of information is good. Too much information that can be conflicting also then doesn't really support decision making. So really interesting to see how that's progressing. Nikki, similarly, WBA is playing quite an interesting role in the space. So not only speaking to many audiences, providing data and analysis, setting expectations on companies, but also kind of acting as a funnel for a lot of multi-stakeholder voices and expertise globally. I don't know how many hundreds of allies you have as part of your network. But if we're thinking of collective intelligence in terms of, finding the deep subject matter expertise that is available globally and somehow structuring and bringing those insights to investors, what role does your ally network play in bringing that to life, and how are those insights getting to investors?
Yeah, so often people know us by the data or the insights, but it's a bit of a giveaway in the title of our organization. A big part of our work is the Alliance. So there's now 380 plus organizations. That's growing every week, and the Allies team is rapidly trying to get everybody on board. And the important thing there is, again, to say that's a really multi-stakeholder lens, and also one that's particularly has regional dynamics that we want to grow and expand in different regions. The Alliance does have financial institutions within it, so that's my main part of my work, which is working with around 50 financial institutions, mostly asset managers and asset owners. And what they come back to me saying that they really value in that Alliance approach, and I think 2 things to really point at. Firstly, it's the methodology development process. So I should first emphasize that we don't want to reinvent the wheel. Nobody wants a new methodology when there are existing fantastic methodologies out there. So when we're thinking about a certain topic or system, of course, we look at what already exists. If there's a strong climate methodology, which is the case for our climate and energy benchmarks, we used an existing framework that was developed by the French government and CDP number of years ago, and we then just benchmark the companies, the data side and the research side, using that existing work. And the same in our kind of food and agriculture, we leverage the expertise of FAIR on the animal protein or of access to nutrition index around the nutrition side. But the end result is then for an investor, and of course any other stakeholder, but what the investor feedback is, they then see a set of frameworks of asks of companies that are holistic and credible, that have been built really trying to gather as much input as possible from all different stakeholders. So the whole point is quite a long process, over a year normally, to develop or build these methodologies if there are gaps that we see, to do the public consultations, and just end up with something that we can comfortably and confidently go to companies, and on the difficult topics, like the engagement that we're doing at the moment with oil and gas companies on the just transition, the first question you're asked by a company is, why is this relevant? This isn't our job. This is government's job. So you need to be able to go back and say, well, we've not got all the answers, of course. Yes, there are going to be areas that we can evolve in these asks, but we've built this by asking unions, by asking all different stakeholders and getting the input to get something that's what we can use credibly asking companies and engaging companies on today. So I think that's one angle, and just briefly the other, it's the network. So I was talking at lunch, and so I don't know if she's in the room, the person I was talking to, but I was trying to describe what I was doing with my network, which was mainly with investors, and linking that to kind of other sustainability professionals. She told me that I'm doing a sustainability dating service with purpose, so I'm going to start using this line a bit more. But yeah, two live cases in my inbox at the moment. I have one large European asset owner who's engaging with a company that said to them, they've been accused of union busting, and the company says, we're not union busting, we're not against unionization, but it's just very difficult, it's not pragmatic, and that's why it's not in our business interest to do this. And the investors come to us just to say, and of course they could go to other people as well, but they happen to be part of the alliance, and they say, is there someone I can talk to just to bolster my second engagement meeting or my collective engagement, which I'm going to move forward? So we connect them with the ITUC, one of the world's largest unions, and build up that case to have a better answer to this kind of pushback. And second example around that, an asset manager in the US who's going to Asia to do some research around supply chains, and they of course can build up their own network, but they just reach out and ask, who do you know on the ground? What civil society organizations should I speak to on this? And I can link them to the nature team who's recently been meeting people there to say, well, this is the people on the ground in Thailand working for Save the Children. They're particularly looking at supply chain management, and that's a start of a conversation that I'm going to learn from when they come back from their trip. So it's very much in this spirit of beyond data, and I think someone said earlier, beyond having the data, it's then moving that to what do we do with it, and how can we evolve that? And yeah, it's an intense, collective, human relationship process.
Yeah, and really harnessing, the expertise that maybe wouldn't be available to investors, especially ones with small ESG teams who don't necessarily have the time to become experts in unionization or food systems or actually any topic specifically. I must say what I also really appreciate about the data, even though it's not all about data, I agree, that is created by a lot of the think tanks, NGOs, civil society, is that while often it is based on company reports, meaning you do look at what companies are disclosing, it's very useful to know what companies are not disclosing, but they should be disclosing. And you're not going to get that by looking at a company's report, because they by definition aren't disclosing that. So it's actually really good to understand what expectations we should be having of companies on all of these issues, and then to understand where they fall short. And I have a question for all of you later about global reporting standards and where all of this fits in, but we will get there. You were talking about engagement, and specifically how a lot of the role of, let's just call it collective intelligence or collective wisdom, is to support investors to be more educated around the topics that they need to engage in. Joe, this is also a lot of what FAIR does. And just for my own work at Matter, we've been kind of looking at a lot of the initiatives that investors are part of in terms of engagement. And it's quite remarkable how many are part of so many different initiatives, quite a lot of which are overlapping. So, you know, there's a couple of the climate initiatives, obviously, GFAN, some of the others. You guys overlap quite a lot in terms of the food system and climate part, and I'm sure have many overlapping investor members. So I guess, you know, this is very good on the one hand, meaning investors are actually actively putting themselves in a position where they are trying to get a 360-degree view of the issues that they need to act on, and to get the information and support to be able to do that. But at the same time, you know, my question is, it just seems very difficult, you know, to actually implement. So if investors are involved in multiple initiatives, how do you guys, I guess, but also the investors themselves, make sure that they're actually getting the most out of this and that they're getting information and they're part of initiatives that they can actually move on and use the information in the best way?
It's a really good question, and one that I've been asked regularly over the years. And I think a couple of things, at least from my perspective, is that I think, first of all, it really depends on what is it that the investor needs and wants. I think they need to know what they need and want as part of their strategic ambitions. And once they, and this can be, for example, it might be that they're looking for data, they might be looking for indicators specifically or frameworks, or they want to be part of collaborative engagements, or perhaps they're just looking for technical expertise, or in even some cases it's about policy, for example. So there are different areas, and not all these initiatives do everything, right? They ultimately do what they're best at. So I think an investor needs to know this from a starting point. I think the second part, and I think once you know that, you can whittle down the list a little bit. But once an investor knows this, I think that the next point is in terms of alignment. As you mentioned, Lisa, there's a lot of initiatives, there's a lot of companies, there's a lot of overlap, and there's us. So I think you need to be considering the level of alignment between these initiatives. You know, are they speaking to each other? Are these initiatives ensuring that if there is overlap from a company perspective, that what companies are being asked to do, is there alignment there? Because ultimately, if there's not that level of coordination and an alignment between these asks, it's ultimately detrimental to not the investor, but to the market as a whole, right? So I think it's incredibly important, and ultimately we're all working towards the same goal. And I think so consideration needs to be given to that. So as an example, from our perspective, we actually spend a lot of time doing stakeholder consultations. And I think on your point, Nikki, you do a lot of public consultations. And part of the role is really speaking and keeping track of the different initiatives and talking about what is it that you're asking, feeding into different indicators. So there's a lot that happens behind closed doors in that regard. So I think if there is an investor that's trying to decide what initiative to join, I think those are probably some of the most two important things that they really need to be looking at. And I'll just pick up on the point that you said just around, you mentioned a 360-degree perspective. And again, it goes back to what is it you need and what is it you want from an investor, because a lot of these initiatives, perhaps they don't do necessarily bottom-up analysis. Perhaps some investors are just looking for pure data points. And again, a lot of the initiatives don't provide that. WBA does, FAIR does. We're obviously very sector-specific in that regard. But I think there's not a straightforward answer, but at least these are two initial starting points to be able to whittle down that long list. But coordination, alignment. If you are part of one initiative and you know that they're speaking to each other, at least you know that there is the positives asks are happening there.
Yeah, because we also need to make sure that as investors are taking into account more information and actually pushing transitions in ways that, integrating a traditional ESG rating was not doing, that we make this quite efficient. There's ESG teams are super swamped at the moment with trying to just report against regulations and meet all these requirements. So I guess it is important to be focused and to make sure that in terms of the requirements of different initiatives, they are getting what they want. And of course, there's many topics, not just you guys where you overlap, but access to medicine, digital rights, all of these very niche and, as I said earlier, often complex topics. Ray, from the investor perspective, so you've talked a little bit about the mindset shift from risk to impact. Are investors adequately starting to integrate these tools? I mean, not you guys at Tribe because you have that specific thesis, but in general, if we're talking about the mainstream, and if so, could you give us some examples of where this is starting to happen, and potentially also touch on what needs to happen to institutionalize this more?
I see a lot of conflation in the market around these terms of ESG, impact, sustainability. For us, all three mean quite different things. And I think that, as you mentioned, Lisa, the regulation coming in will help to differentiate between all of those. Now, if you're a pure ESG investor, then you don't really need to kind of look beyond the ESG metrics, but then end clients need to understand that they're not actually getting necessarily positive impact. They're getting, positively aligned ESG or ESG tilted or ESG aligned, etc. I think impact is something quite different, and it goes back to that simple point of impact and risk on the business versus impact or risk out there on the wider society. So I think we are seeing more sort of maturation in the market around that and understanding of that. And backlashes against a lot of this as well, as I'm sure some of you have seen. Just going back a little bit, if I can, to the engagement point, one interesting thing for me is if you look at a live example right now. So there's a big deep sea mining event going on in Jamaica now, and a decision will be reached, I think, next week on whether to basically open up deep sea mining. So in light of that, obviously, timed engagement is really important to help influence that decision. And I would say probably size matters, right? You want to get a bunch of investors saying, look, take the precautionary principle here. We really don't think this is a great idea without understanding the significant environmental and social and livelihood risks at play before going down this route, et cetera. And that's what sort of happened. So this week we've had over $3 trillion of assets saying that, and that's ahead of a specific meeting and decision to be reached. So I think when you have that type of pinpoint decision, you want scale and timing to come into play. On the other side, I think if you really want action as an investor, and I could speak from the Tribe perspective, having been there a year only, but still, is sometimes when you get 2 or 3 investors engaging one company on a specific issue. It's like anything in life. You get too many cooks in the kitchen and everything gets watered down and you never make a decision. But it's that magic number, right? 3, 4, that kind of on something specific where you can move tangibly and engage very specifically. And we're doing one right now on health transparency and another one on biodiversity. Again, with that kind of number of actors involved, 3 or 4 on something very specific. So for me, I guess, if I can go back to your point on engagement, because it's quite interesting, is that a lot of people talk about it, but you want to see the evidence. A lot of people say they remain invested in the fossil fuel companies because of the engagement that they're bringing and because of the change they want to see. Show me the change. I don't see it. Personally, maybe I'm missing all of it. So I think that's the thing. You want to kind of be able to discern under the hood of not just people saying they're engaging, but what are you engaging on? What are the measures? What is the outcome? What's the divestment plan? What are you going to do if they don't meet these targets? What are you expecting after a year? As soon as you start asking those questions, you get some blank stares, because often the outcome is the engagement, whereas I think for us, and probably everyone on this panel and everyone in this room, the outcome has to be the actual outcome, not the engagement. So I think that there's a lot that can be done in the market on this, and the fossil fuel companies, to me personally, are a case in point example, where in the last year and a half, you've had record profits during a war where people are dying, and you've had, quote, engagement of these companies, and if anything, paring back of climate commitments by the big mega oil and gas majors. So show me the power of that engagement, and show me in the event of these confluence of crises happening now on climate and war, where these engagements have led. And basically, they haven't gone anywhere, in my view, overall. There's some sort of winners and losers in that, but overall. And that's the level of discernment we need, given the climate, biodiversity, nature, social, you name it, crisis we have out there. So I think that the engagement point is really big, but I think we really need to look under the hood and actually see what we're getting from it and if people are actually serious.
I think it's an important point, and also linking to, even if the process of engagement was followed properly, which is not in terms of escalation and when goals aren't met, it also comes down to what are the expectations. So what are the goals that we're expecting of companies? What are the different steps and transitions? When is the point where we will escalate? And I think bringing actual expertise into those topics, because as you say, it's something like deep sea mining. I am not an expert at deep sea mining. Like, to really understand what I should be expecting of a company in this topic, or in something like biodiversity, I think it's critical that we actually do set the right expectations so that we can have the proper gates in these engagement plans. And interested, I mean, if we can just touch on the example that you brought. So you collaborated with 4 other investors. How did you come together with them, and how did you educate yourselves, I guess, about this topic? I mean, and just as context, Ray used to lead the WWF Sustainable Finance team in the UK, so really probably are yourself quite educated about these topics. But how did you bring that consortium together?
Sorry, you mean on deep sea mining, or on other things?
Well, on this specific engagement, yeah.
Yeah, I think on this one, and I don't know if people are aware, but there's a group called Finance for Biodiversity, which some of you may be aware of, and they are bringing together sort of finance sector actors on the nature biodiversity theme. And they actually had the idea of coordinating an investor letter timed for this decision that's going to take place around potentially opening up the deep sea again, or actually the first time ever in terms of in total for possible deep sea mining. So us being part of Finance for Biodiversity, as are, I think, 50 or 100 institutions, I think there were about 30 who decided that we want to sign this letter. For us, it was important to make some noise about it as well, so we've written about it, not just signing the letter and doing a few other things, because it is quite important, and we invest a lot in the circular economy. So the whole idea being that, do we need to mine a lot of new minerals and metals? Clearly, there is a lot of demand for metals and minerals as part of things like EV transition and component transition that we're seeing on the energy side of things. However, circularity plays a huge role, recyclability and alternative materials, and that's where we're sort of playing from the investment side at Tribe. And those are the things we need to investigate first, along with doing the due diligence around this delicate ecosystem that's sort of 70% of the Earth at the moment, so it's kind of important. So I think that this one has been brought to bear by that sort of coalition of actors, and that's where these coalitions can be massively important. And this letter coming out in 3 weeks doesn't have as much significance as it does coming out this week, and I think that's the difference. And then, yeah, I think bespoke engagements, it's around, knowing the constellation of actors, knowing who's invested in certain companies, and knowing where people have potentially had roadblocks. So if as a sole investor you've hit a roadblock, internally with a company, whether it's you're kind of stonewalled by the investor relations team or just haven't made enough progress, often if you combine with other investors, you can have more say within the company, because suddenly you've got 3, 4, 5 investors, some of them big, some of them small, coming to you asking you for the same thing. It's even more efficient from the company's point of view to actually engage on that. And often the response that we've received is, this is number 10 on the priority list. So our job is to make it number 1 or 2. It's not that the companies are not cognizant of the issue, is that how do we get them to focus on it today as opposed to 2 years from now, and what's most important in that. And we'll all have slightly differing views on that, I guess, but that's where it comes from.
Yeah. Thank you. So importance of engagement, importance of escalation, so proper engagement, and importance of setting more rigorous expectations on these topics. And so I have a question for all the panelists. A lot of what we've spoken about in the last 2 days is also ISSB, a lot of the harmonization that we're seeing globally or potential harmonization that we're seeing globally in terms of company reporting standards, TCFD now on the ISSB. And on the one hand, you know, there is the story that it is very useful for us to have one harmonized, or at least a couple of harmonized reporting standards. On the other hand, you know, we do need space for the wisdom of the experts, let's call it that, for much deeper knowledge and wisdom in specific topics that reporting standards aren't necessarily covering in the depth that we need to for proper transitions. This is my opinion at least, but I actually want to hear what you guys think. The harmonization of reporting standards, or the proposed harmonization of reporting standards, is this something that we need, or is it just making things worse? And then what is the role of collective intelligence in this future? Because I guess, you know, in the most extreme example of this, none of your organizations would be serving a purpose in that sense. So interested to hear your thoughts in terms of where we're moving. Anyone can go first.
I mean, I'll jump in. It's definitely very much welcome. It's going to help the conversations with companies, especially with those that push back a lot in terms of saying that there's no standardization, there's no common way of approaching these, frameworks are lacking, or there's no expectation to report on these. So it will definitely help the conversations. Similarly for investors, comparability is important. I don't think there's two ways around that. It's definitely important. I think where there still will be challenges is, and I think it was one of the earlier panels, is these standard setters are agnostic in terms of ambition, right? So I think that's where the role of collective intelligence, as you put it, Lisa, becomes incredibly important, because you need to take context, geographies, sector-specific issues into consideration. Ultimately, disclosure isn't going to fix a lot of the issues that these companies are facing. So there is definitely a role beyond that for organizations like ourselves, but also just from a data perspective, again, is useful, but more still needs to be done. But I think overall, very much welcome.
Yeah, I can add to that. I mean, fully support and celebrate that we've got the first ISSB standards out, and that they're, just to mention here, that they're now consulting until beginning of September. They're consulting on what their next priorities would be. So if you've got views on what should come next, social, biodiversity, and these kind of topics, then get your feedback to them now. Yeah, so they're a very important step, but echoing what Joe's saying and adding to that, you know, we value having more data. That will make our role easier. It means we can move the conversations from disclosure to actually assessing how in line they are with a 1.5 degree trajectory, or these other constraints that we have from an environmental perspective and the social needs. So, but they will take us forward. So for instance, we've just had also the European Sustainability Regulation Disclosure. I'm trying to think of the right The
CSRD.
Yeah, exactly. Yep. The European standards. Obviously, these are going to happen, and the consultation that's just come out, and we just had 1 month to input, so the deadline was a few weeks ago, is kind of what exactly the standards should be and which ones should be mandatory. So we mapped this to what disclosure do we already have. We did find that if those standards come in, which is likely to happen, we will get more information. So it is taking us forward a stage, it's taking us to cover more companies. So this is a good step, but yeah, having the data is not actually about having action. We need to definitely differentiate between those two things. And we've seen it, I just kind of mentioned one area where we've seen that really play out. There was a panel earlier on stewardship, and particularly there was some mention about voting. There's plenty of data in the last 6 months showing where companies are on climate transition planning and all these other topics. Just having that data didn't lead to AGM voting actually reflecting in a certain way. And there's so much more to unpack behind that. So it wasn't a lack of data that we found reflecting on, say, AGM season in particular. It's all the other factors. It's getting the buy-in of investors to support certain resolutions, you know, and the kind of actions which companies take to just convince people, investors and others, to support them. That's the kind of movement that we need, which goes well beyond having the data. So let's get over that kind of data hurdle and move to the action. And there, answering your last point, was there's still going to be a lot of work to do there, and that's where our organizations still need to exist in this space. But if we don't need to exist, then we can retire, and that's fantastic, because maybe we're in a better space overall. But I don't see that's where we are with the new, you know, disclosure frameworks and where we are today.
Absolutely, and I mean, of course, data is only the first step. We need to use it. We need to act on it in the right way. But I'm going to push back a little bit on, you know, let's assume that all the data will be used in the right way. It's not happening yet. Obviously, we need to work towards that. But I do think that there is still a data gap, even with the European CSRD and with the ISSB, where we're not going deep enough into some of the more complex issues that are very sector specific. I mean, thinking about understanding, you know, privacy and security and digital rights and AI for digital companies, and thinking of some of the issues that you guys work on with really trying to understand companies' impact on the world and the social transitions and planetary boundaries. I don't think that the state of data is there yet. So I think we still have a data gap to work towards, or at least, you know, ideally, and then in parallel, kind of focus on turning that into action. And that's, I'm more sort of pushing back in terms of recognizing the work that you guys all do is very, very valuable, because you probably have noticed that I believe very strongly that the expectations we set in the data that we have is a very necessary but not sufficient part of the transition.
Just to say, yeah, the European reporting, this will take it, the confirmation that we had by looking into that into detail was that it goes beyond what we have today. So if we'd found that all this did was just get us to where we already are, then that's not great. So it will take us further, but absolutely, this is often sector agnostic. Even in the European context, it's proposed as not all mandatory. So yeah, there's then the sector specific and the deeper. Yeah, there's a lot of gaps still. So do echo that, but it's a good baseline. We like the baseline.
I agree, and I also support, definitely from our point of view. I mean, we are in the business of collecting, structuring, turning data into insights, and all the more harmonized, standardized data we can get is a step forward for sure. Felix, what is your opinion?
I'm sadly not going to depart from the panel's view that the harmonization is helpful. But maybe just a couple of wrinkles in it. So, I mean, it is super important that the competing frameworks which exist and have emerged in lots of different reasons is hugely frustrating for kind of everyone working in the space, probably particularly companies and financial institutions, but everyone else too. So that's great, and we, like everyone else, are building our work on ISSB's frameworks and some of the existing frameworks, and we see ourselves very much as sort of in tune with that and helping to operationalize it. And that's really my first point, really, that there's a huge gap between the existence of harmonized framework and actually having sort of analysis and information that can power those. Firstly, it's just about the availability of the raw disclosed information, which obviously the mandatory disclosure can help to resolve, but that's also then a building block where we need to say how good is enough. At least in my view, we think that's important, and probably we need to get to a collective view on how to do that kind of part of the jigsaw puzzle. It won't necessarily be within ISSB, say, but that the ecosystem needs to provide that. So that kind of operationalizing what's been harmonized, I think, is still a huge area for us all to work on. So it's probably not time to kind of just celebrate, but it's just a super helpful starting point. And then maybe also just coming back to what I said earlier, I don't think that means that the standards need to be static. it is in the nature of these things that it can be a little bit hard to be nimble once you've tried to pack in a lot of different elements. But of course, we're going to continue to learn and refine our analysis of sectoral transitions. And we need to build the feedback loops back into disclosure and then back into these frameworks so that as we get better clarity on how to grade companies on protein transition, for instance, that can be sort of incorporated within the work. At the same time, we obviously have to work with what we've got today. So that's the kind of universe that we're bridging. And then just the final point is that I think we need to do a lot of work on actually doing the real-time learning with financial institutions and their real use cases and how they evolve. There's lots of conversations and lots of our organizations have contact points with financial institutions. One of us is one. But that's what we're really focused on in the next few months is kind of testing, learning, are our assumptions about the different kinds of use cases, might be engagement, might be feeding information into a new index. There's obviously lots of other reasons, tracking to net zero, risk management in a bank, lots of different purposes, some similarities in the data, but not perfect. So there's a lot of learning for us to do there, I think, and make sure that we're powering all of our work. And I think that is probably how we accelerate the rollout of the higher quality regulation that we need anyway. I think that's not going to come by regulators sort of innovating. I think without the community demonstrating that this is possible, desirable, actually can be implemented in financial institution instances. So that I think that's also how I see it. It's more of a virtuous circle rather than a parallel track of voluntary work and mandatory work. But yeah, it's probably another topic.
I like that, and I agree. Let's hear your last thoughts, Ray, and then we're going to open up for questions. So if you have any questions, you can start thinking about them, and then we'll have a roaming mic.
Yeah, I think the panel's really covered it well. But maybe just to add, if you roll back the clock maybe 10 years ago, this is an extremely welcome point in time, and that we're talking about harmonization of these to begin with, of these standards and regulations coming in, because we were nowhere on all of this sort of decade ago. So that's great and very welcome. I guess the only thing we need to ensure is that it's not watered down in that harmonization process, because that would be bad, and also that they're not necessarily the same thing. And there are people out in the market, including financial institutions, for instance, who say, give me that one nature metric that I can plug into my spreadsheet as I do my climate metric. Now, first of all, as Felix said, the climate metric is still not there, and we have a lot of progress we need to make on that. But also, nature can never be boiled down to one metric. Sorry to break the ice to people who want that, but it's never going to happen. And if it does, it means it's not done properly. It is so specific to location. It's messy. It's not you can't aggregate nature in the way that you can kind of do with climate metrics. Felix, please correct me. But there's a big difference, right? And then this difference then is the case for all kinds of things we're looking at. The food is another space that Joe can probably talk about in terms of it being very location specific and sort of a bit messy in terms of metrics, etc. So I think when we've seen this in the past, often interest parties play a role, and then the harmonization leads to opportunities to take some of the teeth away, and that's what we don't want to see. So that's what I'm slightly worried about. But from the perspective of financial institutions, businesses managing all of this, certainly the harmonization would help. So I think it can be done in a way that keeps its robustness, but that's no guarantee, and we'll have to ensure that that's actually the case.
Yeah. So what I'm hearing is there really is a role for our continuous learning together with regulations, us as, well, commercial data providers, financial institutions, subject matter experts in terms of NGOs and think tanks, to constantly be feeding, because Felix, I completely agree, or it actually might have not been your point, might have been one of the ladies' points, and then please forgive me, that as we transition, things are going to change. We are already over some tipping points, so contexts are going to change, expectations are going to have to change, and that has to be the role of everyone. That is not necessarily the role of a financial regulator who has 120% of full-time job already taken. So I think really the spirit of collaboration and bringing in the expertise that we actually need to solve our really critical, complex transition problem that we're facing. It's really about trying to bring all these voices into the systems, regulations, and financial decision making. Thank you very much. And now we're going to open up to any questions that you might have over there, and then there's one at the front here afterwards.
Thank you. I'm Christoph. I am at the Oxford Sustainable Finance Group. I lead our spatial finance work. Thank you very much for the panel, for a very engaging discussion. I think more or less every statement very much resonated with me, so it's nice to be in an echo chamber of equal minds. I have two questions, but they're related. So we talk about improving sustainable finance data and analytics to do more sophisticated analysis on various more detailed topics and issues. How does the panel see the capacity within financial institutions evolve, or how much has it evolved to actually absorb more sophisticated data analytics? Are we actually seeing an improvement? There are indeed ESG analysts who need to think about many things. There's not enough of them. And investment analysts don't get the time to even look at other things beyond, let's say, an ESG rating. So that's a big problem. So are we seeing an improvement there? And then secondly, linked to that, are we seeing sufficient budget from financial institutions going into more sophisticated sustainable finance data and analytics? How much longer do we need to keep funding these initiatives from philanthropy and public money? And when do we actually get to a commercial business model to support this? Or maybe this is not actually desirable. So I'll be very keen to hear your thoughts, including yours, Lisa. Thank you.
Thank you. Interesting question. Who wants to go?
I can start maybe on this. On the capacity and the ability to digest, because just reflecting, that was pretty much my previous role. I worked at an asset manager before this role, and it was building our own proprietary ESG rating. And what's key, and the way you do that, and it's a trend I'm still seeing, so just like in terms of the answer is absolutely this has changed. And the change has been taking off-the-shelf ESG ratings from an external provider to then bringing it internal and thinking what is our own view of ESG, but then using multiple sources to bring this all together. And the key reason to do that is to have the buy-in of the investment teams to use that data, but also to have it plugged in to the platforms that they use. So these are like key steps that we're seeing, and it's still a trend, and there are, maybe that's the larger kind of asset managers that are doing it, but what's the case across the board in terms of capacity and getting it in front of PMs and analysts who are making the investment decision is that it's plugged into FactSet, Bloomberg, and all these other kind of key systems, which are the day-to-day platforms that they're using. So that's the way to kind of tackle that capacity, and that's definitely a shift that's happened in the last few years and is still happening. Budget and commercial, I mean, just from our perspective, it's deliberately not a commercial entity. You can talk about all different types of funding in the background, but to enable us to be that open source and be independent and not driven by one particular group of kind of clients, it's deliberately set up in that structure. Of course, there are debates about how that could evolve, but I mean, that's deliberately not that we're aiming, it's like not starting as philanthropic and therefore becoming something commercial. That would kind of undermine, at the moment, the core of how we function. So that's just more specific around WBA.
I'd echo what you've just said, Nikki. I think in terms of capacity, I think the other thing has been around, I think investors have become more sophisticated as well in terms of their technical knowledge. And a lot of this has been because, at least from a food and agriculture perspective, FAIR's done a lot of capacity building with a lot of different investment teams to ensure that it's not just your individual ESG teams, but it's a lot of the sector analysts, and because we're also seeing very specific mandates as it relates to sustainable food systems. So there's definitely been an increase in the level of sophistication, and we've also had to respond to that, making our work a lot more accessible and in different formats, for example. And from a commercial perspective, again, we're very much mission-driven. It is around how do we build a sustainable food system. And similarly to Nikki's point, it's around ensuring that we maintain our independence and that we're not biased in terms of the work we produce, but also from a corporate perspective. I think the feedback that we get from a lot of the companies that we engage with has been that you are ultimately the sort of conduit between the investors and the companies, because again, I think going back to an earlier point that Felix made, we're seeing a lot of frameworks come into play, but from an operational perspective, companies, it's going to take time for them to be able to report against these issues, and it's our role to manage some of these expectations as well. So again, I don't think that we'll be going commercial anytime soon.
I'm just looking at time, so Felix, Ray, happy to jump in, but just be aware of time because there is at least one more question here, and I'm not sure if there are more. But we've got 5 minutes, so go ahead. Yeah.
The only thing I would add is you're looking at the ESG or sustainability teams within an institution, but you should also be thinking about what's the other side of the business. You know, what is the traditional side of the business doing? And once an organization realizes that actually it is all about sustainability, that's going to be our investment proposition, then the budgets and processes and systems will follow. So if you've got a sustainability team that's growing at X, but a normal team growing at, you know, X times Y, then there's going to be your answer. Yeah, just my simple answer.
I see you nodding, Felix.
Yeah, I was going to say that point, but there's one other point that I can make. Because we're a new organisation, we're spending a lot of time visiting different places in the world, different markets, to listen to what financial practitioners and the organisations they work with are, the problems they're seeing day to day and what they really need. And our particular focus in that has been, we would like to see more companies being analysed in those regions, and so we have the analysis of the transition. So that's been our, and capacity building through that in those geographies. That was our starting point. Actually, what we're hearing a lot of is, in addition to that, a real need for upskilling of people involved in financial decision making in lots of different contexts in those regions. But actually, I suspect it occurs, this is probably the case internationally. And we're thinking about how to close that gap, and we'll probably be doing work in that area. But this comes back to the second point. At some point, we can't just be providing services to financial institutions that is just helping them do their work. So we'll have to think about an appropriate model for that. But we haven't taken decisions there, but our starting point will be maybe we charge financial institutions to cover those costs, and those costs would be higher in Global North and, you know, very low in Global South, for instance. But we do need to bear in mind that philanthropy is scarce capital and it should be focused on public good. Completely agree.
And we're going to take your question now. I might just say, find me in the break, and I'll have a comment about the commercial side, because the matter is commercial, and we do integrate a lot of these insights and work very collaboratively with who we see as global collective wisdom. And then just, you know, the answer to your basic question is it totally depends on the size of the financial institution. The guys with bigger ESG teams have quite a lot of really interesting capacity and internal data architectures. The smaller guys, I think, are really struggling, and most teams are really drowning under regulations at the moment and spending 80% of their time just trying to report to CSRD and other regulations.
Yes, if I can just... Hello, can you hear me?
Yep.
Yeah, just very quickly, two binary questions, essentially, yes or no kind of thing. So the first one is, you know, when we talk about positive impact, then of course impact, there's inherently a notion of causality inside. So I was wondering, to measure impact, do we use causality or do we use correlation? So causation or correlation. This is the first quick binary answer, question. Then the second one is, for example, for COP26, there was the Global Assembly, so there was a concept of participatory democracy, and I was wondering, are you aware, or do you know if there's any initiatives instead of participatory finance or deliberative finance, so having a representative sample of society and see what people put value on, a sort of a wisdom of the crowd kind of thing, not on the analytics, but mostly on the portfolio diversification. Thank you.
I might just ask you to, I'm not sure if I'm the only one, but I might just need you to redo the second question. I'm not sure I fully understood.
Right. So for COP26 in Glasgow, they sampled essentially 100 people from all over the world to form the General Assembly. And these people gather up, I mean, they went through a formation period. Then they discussed about different possible solutions about climate change. And there was a report and follow-up report and so forth, to try to merge ideas, you know, to try to see what people think about how we should and we could solve climate change. then for finance, I'm wondering, because we do this on the democracy side, right? So for the politics side, are you aware, so yes or no, this is the binary part, are you aware of any initiative that is doing this, but on the financial side? So how people, may, a representative or as possible, as representative as possible sample of people, our society, how it is spreading value in finance, for example. Thank you.
I can take the second one, and the short answer would be no. I'm not aware of there being an existing initiative trying to do a kind of what you're saying. I think it's a good idea, what I can say is in our work, in thinking about how we communicate what our purpose is to general public and other kinds of stakeholders, and it might be that we actually do more work specifically in this area in future, we have to think about how investment decisions or financing decisions can be connected to, so that people can understand what we're talking about. Because I think it's often assumed this is only something that happens in an investment house or in a bank. But obviously, actually, households are taking decisions that involve financing or allocating capital in different ways all the time, particularly struggling at the moment to figure out how to do that best in challenging circumstances. We have to find ways to build those bridges. But I think if we can do that and use that as the ground for a conversation about then taking it back up to how we organise ourselves as countries or in other ways to think about financing the transition, I think that would be a healthy thing. So I think these are two, at the moment it feels like beating up the banks because they're not doing enough, which probably they're not, but it's very hard to make that tangible to people, exactly what would be good enough and what does that mean and what kinds of things are they actually doing in these, what appear to be quite black boxes if you're not sat in one.
Impact, causality, yes, no?
I can maybe start on the first one and maybe be added to that. I think it's a bit of both, and sorry not to be black and white on that, but it comes down to as well, is it primary issuance, is it secondary issuance, is it private equity, is it public markets? But what I would say is that my view is that we have to have impact through every channel, so that you'll see lots of discussion around this. You'll see lots of discussion around, does private equity achieve more impact than public equity, because it's more direct, but it's only a tenth the size, and there's all this debate. I think that's the wrong question. The question is, how do we achieve, given the time we have on all these issues, the most impact through each channel, rather than worrying about that. And so even if it's a correlation-related impact that you're beginning with, so let's say secondary markets, right? Someone sells a share, Tribe might buy the share, what's the real impact? Well, we won't get into it now because we don't have time, there is impact through that, but also, if we own the share, we may do some engagement on something very specific, and that correlation suddenly then could turn into causation. If we're asking for something specific that gets enacted by a company, that to me is causation more than correlation, because you can actually attribute it back. So you can go from one to the other as well. So that's how I would answer that. Obviously, causation is great, but sometimes the big systems change stuff has to be correlation anyway. So both can be really important as well, and it also affects cost of capital. So sorry, it's not really a binary answer you're looking for.
I think we could probably have an hour-and-a-half panel on this impact debate, for sure. We have run out of time, unfortunately. Wish we did have time for more questions. I will just say that we have developed an NLP model to basically assess, we look at global media, so daily feeds of media, about 75,000 articles a day, and assess whether the public sentiment on companies is changing according to the SDGs. It's only answering a very small and specific question and should only be used to answer certain questions, but you do see if there's environmental violations or gender issues in the media, you really do see the public responding with sentiments, changes in sentiment. So there's different questions, I guess, that we can answer, but in general, data points should only be used for the specific thing that they're answering, and not more than that. Thank you so much for coming to listen. Thank you so much to our panelists for being with us today. And yeah, we've got half an hour break now, so I'm not going to keep you any longer. Thank you.